Joining us now, Ruchir Sharma, Rockefeller International Chairman, and he's the founder of Breakout Capital. All right, Ruchir, you want to go through them 1 through 4 quickly if you have time? Tell me whether we're in fact in a bubble?
Yeah, David, as you know, there's a bit of a bubble in bubble talk these days, which is that everyone's talking about a bubble, but there is no standard definition of a bubble. So what I've tried to do in my FT op-ed this morning is to lay out a framework, which is that what are the 4 O's, so to speak, to look for to know whether we're in a bubble or not. And those 4 O's are overvaluation, over-ownership, over-investment, and over-leverage. Now, very quickly to go through these, for overvaluation, I think the case is being made. I also look at prices, which is that if you look at bubbles historically, the big bubbles in history, which is that prices in inflation-adjusted terms typically tend to rise 10 times over a 10 to 15-year time horizon. And that's exactly what we've seen for the US tech sector over the last 10 to 15 years. And valuations, we know, are in the 95th percentile or so on most metrics currently, with only 99-2000 standing out as a period where valuations were high. Then briefly, as far as over-ownership is concerned, and here I think we have some of the most telling statistics here, which is that today, Americans have 52% of their wealth, financial wealth, in the stock market. That's higher than where we were in 2000. In fact, America is possibly the only country in the world today where people have more of their savings in the stock market than even in property. So you have so many young people today who are just trading and saying, we can't afford to buy a home, let's just punt around and try and make money off the stock market. Over investment, well, tech investment as a share of GDP now is at 6% of GDP, again, higher from where we were in the year 2000. And lastly, on over leverage, here I think that there's some degree for comfort because despite the ramp up we've seen in AI debt, the households and the private sector in general are not that leveraged, at least compared to previous cycles. The only fault line being here that the government is where the leverage has been built up this time. So putting it all together, I think you can say that we are pretty much in the advanced stages of a bubble.
We are in the advanced stages. All right, to counter that, I would say, well, obviously the leverage point's an important one because these are amongst the largest companies the world has ever seen. In fact, many of them are. And so they have the capacity to add a lot more leverage. And therefore, to your point, or perhaps not, we're not over levered. But their stock market performance, Meta shares are up 9% this year. Amazon shares are up 2%. Microsoft is up 12%. All three underperforming the S&P, all three part of what we certainly would describe as the center of the AI efforts that are underway, given the CapEx they're spending.
Exactly. But I think that that's what's happening, that these companies were being valued a lot because of the amount of free cash flow that they were generating. But that free cash flow growth is now declining sharply. And I think that that's what they're paying the price for. And, you know, at this time last year, I had said that the big trade was going to be that American exceptionalism was about to come to an end. And I think that's what we are seeing as well, which is that America is spending so much on AI, but it's very interesting that the rest of the world's stock markets have done far better than America this year, possibly the widest gap since 2009. So I think what's happening is that, yes, in America, we are spending a lot on AI, but I think there is a quiet questioning going on as to whether all this investment is actually going to pay off. And also a realization that the American economy has become very dependent on AI. As I've discussed here previously on your show, there's become one big bet on AI. So, of course, I know that these bubbles can last for a long period of time. And as I conclude the article even today by saying that the one single catalyst going back 200, 300 years, which has ended every single bubble, is when you get a rise in interest rates. That is the one catalyst. Otherwise, there's no science behind saying, oh, this valuation is too extended, at this valuation, the bubble has to end. That doesn't happen. But the moment you begin to get a rise in interest rates, whether it's short-term or long-term, any sign of tightening in financial conditions, and that's what typically pricks a bubble.